Right now, as you watch this video, somewhere in the Persian Gulf, there are over 150 oil tankers just sitting there, engines idling, crews on standby, because they literally cannot move. The Strait of Hormuz, the most important energy choke point on the entire planet, has been effectively shut down. 20% of the world's daily oil supply, gone, just like that. And here is where it gets absolutely wild for us precious metals people. Gold just shattered every single record in history, blasting past $5,400 an ounce. But silver dropped, platinum dropped, palladium dropped. Every other metal fell while gold went vertical. And if your first instinct is to say, wait, that makes no sense, then you are in exactly the right place, because today we are going to break down exactly why this is happening, what the analysts are saying, and most critically, what you as an investor should be doing right now. Welcome back, everyone, to Silver Signals. I'm your host, Yali, Jiang. And this channel is where we cut through the noise of financial media and give you straight, honest, deeply researched analysis on gold, silver, and the precious metals market. If you're new here, welcome. And please do hit that subscribe button right now, because the content we are putting out in 2026 is some of the most important we have ever made. The world is changing fast, and the precious metals market is right at the center of it. Today's video is one I have genuinely been anxious to record, because the events of this past week have been nothing short of historic. And I want to start by giving you today's market snapshot, so you have the numbers in your head as we talk through all of this. As a market close on March 5th, 2026, gold spot price is trading around $5,300 per ounce, having touched an intraday high of $5,417 just days ago. Spot silver fell approximately 1.5% to around $32 per ounce at its recent low, though silver did post its own gains earlier in the week before pulling back sharply. Platinum dropped 0.5% to roughly $2,138 per ounce, and palladium declined about 1.2% to around $1,654 per ounce. And Brent crude oil, pay close attention to this one, surged more than 10% in just days, with some analysts warning it could break through $100 per barrel if the Strait of Hormuz remains disrupted. These are extraordinary numbers, and there is a story behind every single one of them. So let's start with the big question. The one that is probably why you clicked on this video in the first place. Why is gold soaring while silver is falling? Because on the surface, that seems contradictory. They're both precious metals, they're both historical stores of value, and they've both been considered real money for thousands of years. And the answer comes down to one fundamental concept that every precious metals investor needs to tattoo on the inside of their brain. Gold is pure safe haven money, while silver is 50% safe haven and 50% industrial metal. That distinction matters enormously right now. And here is why. When geopolitical conflict erupts, and we are not talking about some regional skirmish, we are talking about Operation Epic Fury, the coordinated U.S. and Israeli strikes on Iranian nuclear facilities launched on February 28th, resulting in the death of Iran's supreme leader, and triggering the most serious military escalation the Middle East has seen in decades. When something like that happens, investors do not think clearly, they panic. And when they panic, they flee to the most trusted, most liquid, most universally recognized safe haven asset in human history. And that is gold, not silver, not platinum gold. There is a reason central banks around the world hold gold in their vaults and not silver bars. And there's a reason Goldman Sachs raised its year-end gold price target to $5,400 per ounce just this week. There is a reason JP Morgan is now projecting gold could reach $6,300 by the end of 2026. Because in a crisis, a real, serious shooting war in the Middle East crisis, gold is the asset the big money runs to. And right now, the big money is running very, very fast. But now here is where silver gets complicated, and I think a lot of retail investors are genuinely confused by silver right now. So I want to spend some real time here. Silver's industrial demand accounts for a massive portion of its total market. We are talking solar panels, electronics, semiconductors, green energy technology, electric vehicles. Silver is literally inside the devices, the panels, and the batteries that are powering the clean energy transition. And that is normally a beautiful thing. It gives silver a structural demand floor that gold does not have, but in a war-driven global slowdown, that industrial demand story suddenly becomes a liability. Because if the conflict disrupts global trade, and the Strait of Hormuz blockade is doing exactly that right now, manufacturers that rely on silver for their supply chains start facing margin pressure, and global growth expectations get revised downward. Analysts at major institutions start talking about stagflation risk. And when that happens, the industrial demand component of silver's price starts to look vulnerable. So silver is not falling because it is weak. It is falling because one half of its identity, the industrial half, is being repriced lower in real time. Think of it this way. Imagine you have two stores on the same street, One sells only gold jewelry, pure luxury, pure desire, pure emotion, and the other sells both gold jewelry and industrial tools. Now imagine there is a hurricane warning. Everyone rushes to the jewelry store because they want to convert their cash to something durable, but nobody is buying industrial tools during a hurricane. That is essentially the dynamic we are watching right now. Gold is the pure luxury store, silver is the dual-purpose store, and right now the hurricane warning is blaring. I want to pause here for a moment and ask you something genuinely, and I would love for you to tell me in the comments below. Are you more of a gold person or a silver person when it comes to your precious metals portfolio? Because I think this divergence we are seeing right now is actually forcing a lot of investors to reconsider their allocation. And I find that genuinely fascinating. Drop a comment, gold, silver, or both. I read every single one, and your answers genuinely shape the content we create on this channel. Now let's talk about the Strait of Hormuz, because I do not think most people outside of energy and commodity markets fully understand just how insane the situation there really is. The Strait of Hormuz is a narrow waterway, just 21 miles wide at its narrowest point, sitting between Iran and Oman, and through that tiny passage flows roughly 20% of the world's entire daily oil supply, around 20 million barrels per day. Also flowing through it is about 22% of global liquefied natural gas trade, and Qatar, one of the world's biggest LNG exporters, had its facilities at Ras Laffan hit by Iranian drones. The strait is not just an oil route. It is the single most critical energy artery on the planet, and right now it is effectively closed. How did Iran close it without a formal naval blockade? They did not lay underwater mines, and they did not deploy warships in a classic naval blockade. As RBC Capital Markets' global head of commodity strategy put it, all Iran had to do was carry out a handful of drone strikes in the vicinity of the strait, and that was enough. The moment those drones struck, insurers pulled their coverage, and shipping giants like Maersk, Hapag-Lloyd, and CMA CGM, the backbone of global container trade, suspended all Strait of Hormuz transits immediately. Ships started rerouting around Africa's Cape of Good Hope, adding weeks to transit times and dramatically increasing costs, and over 150 tankers are currently anchored outside the strait. On March 2nd, satellite tracking showed essentially zero tanker traffic through the waterway. Zero. The most important oil choke point in the world, completely silent. As one analyst from Clearview Energy Partners described it, this is about as wrong as things could go at any single point of failure in global oil markets. And here's the critical link to precious metals that most mainstream financial news is glossing over. The Hormuz crisis is not just an oil story, it is an inflation story. Oil feeds into literally everything: transportation costs, manufacturing costs, food production, energy bills. And if Brent crude breaks $100 per barrel, and some analysts think it could go much higher if this drags on, you are looking at a broad-based inflationary surge that would ripple through every economy on Earth. That is exactly the environment where gold thrives. Rising oil means rising inflation. Rising inflation means the purchasing power of cash is being eroded. And eroded purchasing power means investors scramble for something that holds its value across centuries. Gold has done exactly that for 5,000 years. It has no counterparty risk, and it cannot be devalued by any government decree. When missiles fly and inflation looms, gold is not just an investment, it is financial survival instinct. And that is precisely why we are seeing this historic price action right now, because the market is pricing in not just the current conflict, but the long chain of economic consequences that flows from a disrupted Hormuz Strait. There is also a massive dollar story playing out here that is giving gold an additional turbocharger. Normally, and I mean historically in most crises, when global fear spikes, the US dollar surges because investors rush to dollar-denominated assets, and we did see some initial dollar strength. But analysts at TD Securities wrote this week that gold is set to benefit from geopolitical instability, lower risk appetite, and inflation concerns driven by skyrocketing energy costs. And here is the fascinating twist. While the dollar got an initial safe haven bid, the Federal Reserve is now caught in a nightmare scenario. If they raise rates to fight the oil-driven inflation, they risk crushing an already fragile global economy. But if they hold or cut rates, inflation could spiral. And that uncertainty is actually a second bullish force for gold, because gold performs best precisely when monetary policy is confused, unpredictable, and reactive, which right now it absolutely is. So gold is not just benefiting from fear, it is benefiting from the fact that the world's most powerful central bank has no clean answer to what is happening right now. Add to this the central bank buying story, and this is a structural force that frankly does not get enough attention. In 2025 alone, central banks around the world added over 860 tons of gold to their reserves, with China, India, and nations across the Middle East and the Global South all aggressively diversifying away from the US dollar and into physical gold. Why? because gold cannot be sanctioned. You cannot freeze a country's gold reserves the way you can freeze dollar accounts held in the global banking system. In a world that is fracturing into competing geopolitical blocks, physical gold is the one truly neutral reserve asset. And as long as that trend continues, as long as the de-dollarization of global reserves continues, there's a structural floor under gold prices that is completely independent of what happens in the Middle East. Goldman Sachs analysts pointed to exactly this shift in their buyer base analysis when raising their target this week, noting net inflows into Western gold ETFs, surging demand from high net worth investors and family offices in physical bars, and growing use of gold options as a hedge against long-term currency debasement risks. This is not speculative retail money chasing a hot trade. This is the most sophisticated money in the world making a long-term structural bet on gold. Now, here's the moment I promised you, the aha insight, the twist at the end that might genuinely change how you look at everything we have discussed today. Silver right now is in one of the most interesting setups it has ever been in, and it is because of the gold-silver ratio. As of this week, with gold near $5,300 and silver around $32, the gold-silver ratio is sitting at historically extreme levels, well above 150 to 1. And historically, throughout most of human monetary history, 1 ounce of gold has bought between 40 and 80 ounces of silver. We are currently at a ratio that is literally unprecedented in modern history. And what does history tell us happens after extreme ratio spikes like this? Silver dramatically outperforms gold on the way back down. Think about what that means. If gold stays at $5,000 and the ratio simply normalizes back to the historical average of 60 to 1, silver would need to be trading at $83 per ounce. And if the ratio goes to 50 to 1, silver would be at $100. And some analysts are projecting scenarios where silver could hit $150 or beyond in 2026. Now, I'm not saying that is guaranteed. Nothing in markets ever is. And silver right now has real near-term downside risk if the global industrial slowdown deepens. But as a medium to longer-term asymmetric opportunity, the case for silver is actually being quietly built right now, underneath the noise of the gold headlines. Because when the war premium fades and the industrial outlook stabilizes, silver's dual role, both monetary metal and green energy metal, positions it for an extraordinary catch-up trade. And the smart money already knows this. So let's bring this all together. Do not panic about silver's short-term weakness because it is behaving exactly as its historical pattern dictates during crisis onset. Initial underperformance versus gold, followed by dramatic outperformance as conditions stabilize. If you are a long-term holder, this dip is noise, and if you are a new investor thinking about allocation, consider this. Gold right now is the risk management tool, and silver right now is the asymmetric opportunity. They play different roles in a portfolio, and right now, more than ever, you want both. Watch the Strait of Hormuz situation closely. As one energy intelligence analyst noted, even if the strait avoids a full permanent closure, sporadic one-off tanker attacks are enough to keep global markets on edge and inflationary pressures elevated. That is a gold-supportive, silver-cautious environment in the short term, but keep your eye on the gold-silver ratio as a forward signal. When it starts compressing, when silver starts closing the gap on gold, that is historically one of the most powerful signals in all of commodity markets that a precious metals bull market is entering its most explosive phase. And perhaps most importantly, do not let short-term price moves shake your conviction in the long-term thesis, because we are living through a genuine structural shift in the global monetary order. Central banks are buying gold at record pace. The dollar's dominance as the world's reserve currency is being challenged. Inflation risk is being repriced, and energy security, which underpins everything, is more fragile today than at any point since the 1970s oil embargo. The fundamentals for precious metals have never been more compelling. Stay the course, stay informed, and never stop doing your own research. This brings us back to where we started. 150 tankers sitting idle in the Persian Gulf, 20% of the world's oil supply frozen, and gold at $5,300 and climbing. And silver temporarily falling, but quietly, patiently, historically, preparing for what comes next. The precious metals market in 2026 is not just about price charts. It is about understanding the world that is being built in real time and positioning yourself on the right side of it. If you found this analysis valuable, please hit that like button. It genuinely helps this channel reach more people who need to hear this information. And if you're not yet subscribed to Silver Signals, do it right now. We have so much more coming on the gold, silver, and broader macro story as this situation in the Middle East continues to evolve. I am Yali Jiang. Stay sharp, stay informed, and as always, watch the signals. I'll see you in the next one.